Alright guys, glad to have you on board again today. Sorry for the lack of content over the recent days. I've warned you about that. This is current holiday time for me. Therefore, the time I have available for educational content is greatly reduced. But anyway, I think today I have a few minutes ahead of me, and it would be useful to spend that time updating the scenarios, because of course you might have noticed the recent volatility, the XRP ruling for the crypto market, and stuff like that. Though we're going to cover this, have a look at once again the data points. We're going to look at the charts more than anything else. Because if there's one thing I would like to talk about as a quick intro in here is that, well, yes, once again, we're reaching out longer term time frame context, which is, well, this is where value speaks more than just a short-term volatility. But as usual, I see the same old gamblers. I like to call them the blank fillers. These are the guys who come and go over the times, and I've seen them by hundreds over the decades I've been trading. This is the same old story, people mixing up trends and ranges and whatever, and just trying to fill out the blanks by endlessly talking, creating complex models out of nowhere without even thinking about looking at a chart in the first place. So that's really very dangerous to do this, and you know that I've been working my own modeling very dramatically over the latest few weeks and months, and that wasn't just filling the blanks, that was just once again building models out of a context. I'm not building the model in an irrelevant context, aka the same old story. There are three market states. There are excessive markets, which have nothing to be confused by trends. There are trending markets, which have an inherent structure, and they are not endless way trends can be created. The difference between a trend and any other market is that the trend is followed by value. So the statistical asymmetry on prices keep going up or down is always going to be statistically relevant in trends. That's why we call, follow the trend. When there's one, you definitely want to be profiting from these asymmetrics. But on the other hand, well, most of the time people create trends inside ranges. They don't zoom out to a larger time frame, and what they're actually studying is nothing but an oscillating sequence. And this oscillating sequence is a range. And when you have a range, well, that's why the first thing I teach you with the strategy is how to handle these ranges, how to let go with the number two destructive biases of any trader I've came across throughout these years, is the fear of uncertainty and the lack of patience. Because in ranges, you don't know, and by not knowing, if you keep following the goddamn narratives circulating on socials, you're always going to be proven wrong. Because these narratives generally follow the excessively uncorrelated price structure. That means it generally tends to be doing exactly the opposite, exactly what the prices are doing, which means you will have bullish feelings when you're on the top of a range, and therefore the opposite way around. The bearish narratives will be the strongest when you are at the bottom of the range. AKA, this is how you should have a contrarian vision. That's exactly the state I'm in now. I am contrarian to most of the narratives that I hear around that, not because I like to be contrarian, just because I have clear evidence that these guys are building narratives right in ranges. Okay? Though define those ranges, find the boundaries, and when you see these guys fulfilling their prophecies of trends inside ranges exactly at a range boundary, you don't want to be listening to them. You want to listen to the charts and do what you have to do. So now let's look at those charts. What the S&P 500 story tells you is the thing that we've mentioned over and over again through the latest few weeks. This area is on a trending behavior. We've seen the moving average stepping aside from the context and stuff like that. So there are probably trends on the higher time frames on the S&P 500. We mentioned that we're in secular bull market, and even though the monthly chart could start to look like it is a bit excessive, it's still going to require more than just two context boxes. It's definitely excessive, and one of the reasons is actually the number one narrative of the moment. It's all about liquidity, and you see everyone putting out those charts of liquidity, which is itself very excessive. But despite the S&P 500, who, like you see, has been trading a disparate context, meaning breaking the top and bottom boundaries just 2 times. It happened 2 times. Yes, liquidity has been very much a very hot topic, responsible for some of the gains in the S&P 500 post-COVID. Yes, and that was true. Does it make it a statistically relevant pattern? Well, absolutely not. Absolutely not. Because as you can see, if you want to unwind that narrative, just look at the liquidity. And the liquidity, this one, boy, it is excessive. It's been breaking the context boxes 1, 2, 3, 4 times, 4, 5, 6, 7 times. And now we're breaking the opposite way around. So remember one thing, the difference between market excesses and market trends is that the excesses can go from bullish to bearish without ranging. That means this thing could reverse course. So the true narrative being here is what you should be thinking of now, and that's the reason why, by the way, I am mentioning these fucking inflation figures every week, is I think we will stay there. That means stagflation. I'm assessing that this thing that people call a trend is not one, and that the best guess I can get is that this thing is never going to go higher than the third range boundary, if it does one. And I'm also aware of the fact that these things can go from bull to bear, which means to me the risk is deflation. We could get deflation, and if we have it, it's not going to be pretty. But until we have that, and that's why I always get to look at this thing. If this thing crosses in negative territory and stays there, I'm going to be worried and I'm going to invalidate my thesis, because that's the last thing we need to talk about. Those models, they don't trigger trades. They either confirm trades that you've taken for statistically relevant reasons, aka real patterns, indicator-related patterns, okay? And you use those models to confirm the data points or not. But that's the way it goes, never the other way around. You don't trade because of these numbers away from statistics, because the difference between the two is that this thing, yes, we certainly have some data points, but if you were to zoom out this thing over 5 or 6 years, what you will end up with is a range. It's an oscillator. So this thing don't trend. And you really, really can't predict and project trends into this. It's going to reverse at the range boundaries, and that's really, really the likeliest outcome now. So the thing is that we're in a speculative area for that range. That's the reason why I've been forecasting that inflation could rebound, not to go to the moon, 50 or whatever percent inflation out there. That's really not the case. But I think we're in an area in which it's the appropriate time to play the contrarian thing. People think that inflation has collapsed and we're on the verge for deflation. I disagree with that, because once again, the statistical data points in here are ranges, though I don't follow the narrative. We're probably at the bottom of a range because, yeah, people think deflation is down the corner. That's not what I think, okay? That doesn't mean I'll be right. That just means, statistically speaking, at a range boundary, I don't follow the trends. Because it leaves two other options. Either the market will do nothing, or the market will reverse. But any other way around, if you keep playing trends at range boundaries, the only thing you end up with is actually the opposite statistic occurrence. Most of the time you actually just stay there, which is the beauty of this thing. People generally tend to like trend following, even when they do this at range boundaries, because most of the time the market just does nothing. It doesn't reverse to prove them wrong, it just doesn't prove them right. And it stays there long enough so that these guys changes their narrative to the next thing, and this is how they get out with it. Actually, they're not making any money. Most of the time, they enter just pretty much at the same price they've been trading. They exit at the same prices they've been entering on. And they change gears and reverse strategies and over again. Most of these guys are actually filling the blanks by following trends exactly at the range boundary. Why do they do that? Well, just because they hate being proven wrong. And these strategies are very, very efficient at not being wrong. Because most of the time, the market will just do nothing. It isn't going to prove you right, but it's just not going to prove you wrong. Though, please guys, stay away from that. If there were to be a third kind of bias, most dangerous bias of people, it's this, the fear of being proven wrong. Just don't mind it, all right? Just try to follow the goddamn strategy rather than trying to not being wrong, all right? That was just a quick recap. Okay, back to the chart. So remember, once again, you can't just fulfill your prophecy around liquidity and say, okay, if liquidity goes up, every asset will go up to the moon, bro, whatever. If liquidity goes down, we'll all bust. Everything will be destroyed. We're all going deflation. That's 2000 bubble explosion type again. Well, doesn't make any sense to me. At least there is a risk. And I'll look at the trueflation data point to confirm that risk has happened or not. For now, we're still inflationary. We're probably at the bottom of a range. So I'd rather like to be trading against those who think we're deflationary right by a couple of months away. I disagree with that. They might be right, I might be wrong, or the other way around. The difference is I have a statistical viable occurrence on my side. They don't. They create narratives of trend at range boundaries. All right? So, on the other hand, like we stated, this is clearly excessive, and market excesses can go to infinity. So, the QE to infinity, yes, that's also a viable alternative. Reason why and where are you going to be either validating or invalidating that thesis? On the third range boundary. If the market retraces there, this is where you'll see all the QE to infinity folks going like, yeah, we told you so, these things are going to the moon, bro. I'd rather like to be trading against them at that time. Really, really, I will. Okay, so that's the reason, folks. The likeliest outcome for liquidity is what we've mentioned. The best case scenario is doing nothing. The worst case scenario is reversing. And on these excessive markets, the probability of reversal is more significant than you think. So is the deflationary risk real? It is. Does that mean I'm anticipating it? I'm just looking at the data points. If they confirm deflation is here, I will follow suit. Okay? Though, what I am mentioning now instead is, you know what narrative I've been choosing. This narrative of, okay, we're probably going to stay there for quite some time. Because, of course, this thing isn't a random series, okay? It's been going through the roof and absolutely nuts in terms of valuations or devaluation of the currency. But also, it's hard to imagine deflation. Because, well, if we truly go deflation with that much depth in the system, well, like I said, we're going to break everything. So that's really the reason why I also think the likeliest outcome is not moving liquidity around. The reason why I'm doing this is because, well, if you have a look at it, okay, this general liquidity scheme, have you seen it going down any time in the past? It never did, even if you pull out a log chart. The thing is that this thing either ranges or go up. So the likely outcome in here is for us to range. That's the reason why the liquidity narrative to me is nothing but same old story. On the bottom of the range, on the support context, people will fear of deflation. On the top of the range, people will do exactly like they did before. QE to infinity narratives would likely be invalidated as well. Just like deflation probably isn't going to be a thing, the QE to infinity probably isn't either. There will be one time for QE to infinity again. It's probably going to be when we're going to be trading at the resistant context, and I can guarantee you that. Same old guys who will do the same old story, just go for the narrative when the time feels appropriate to talk about it. But if you look at the data points, the only consistent thing over there, this already gave you the answer. Both of these folks are wrong. They're trading what they see in a range, and they're feeling the trend continuation stuff. All right? Though despite that, what is the thing that I personally look at now because, well, it's in an interesting context as well? That's the dominance system. And it's actually working exactly the same now, both in the crypto sector and in the S&P 500. And this is where you need to spend your attention to, okay? So, of course, the liquidity is one thing. Could be either valid or invalid, but you should have made your choice already, because now the market is in fear of deflation mode, and you rather like to be already on board if you were trading that narrative. It's not the time now to fear deflation. If you fear that, you would have traded before. Now, it's the opposite way around. Are we going to get new liquidity injected? And if so, it's now that you trade it, and you're going to take your profits right at the third range boundary, exactly when people will sell you the QE to infinity stuff. What's the difference? Well, these guys talk. You look at a chart to define your statistical outcomes. The difference is, well, your statistical model, be it my indicators or anything else, they are not related to liquidity or one thing. They are not an invented pattern out of nowhere and something that happened 3 or 4 times in the past. It's literally something that can be applied on endless numbers of data series. And to be honest, these models, they're actually usable outside of trading. I've seen some people working on PhD who's been using my models to statistically predict cancer cells. So these things work far off from just trading. It's really, really how to statistically predict with quite a good occurrence the following possibilities of a series of dots. The longer the dots, the more precise the indicator will be on selecting the context. Is it going to be a trend, a future to-the-moon scheme, or is it just a range? Well, when you look at that data series points in here, it's definitely a range. It's definitely a range. There's no way around that thing. This is a range that has been statistically more bullish than bearish. As you can see, the moving average has never crossed over or under the context, which means this isn't a trend. It has been going up since then, okay? Question is it going to trend down now? We don't know. But for now, the only thing we can tell is that where do we come from? Where are we likely going to go? Okay? That's the only thing you should worry about. This thing is the dominance equivalent for crypto. On crypto, it's like the RSP, which is the equally weighted S&P 500, or divided by the S&P. It's basically the market breadth measured. And of course, this thing is an oscillator. Of course, this thing is a range. Because the market concentration, or dominance for crypto enthusiasts, it's the same thing, okay? Market breadth, dominance, whatever. That just tells you that when this thing trends down, that means the concentration of assets is increasing. On the other hand, that means the distribution of gains among the S&P 500 are more diversified. Okay, so what does that thing tell you? Is that it tells you that, for example, out of the 2000s, which were an extreme concentration in few assets, we've only trended up. Not trended, but we've moved to higher valuations with rising peaks and troughs. Are we on the verge to do the opposite? Meaning we're going to reconcentrate assets down to 2000 and like similar levels. Well, that's a possibility. Now, do you trade that now? Well, those who trade that narrative, they have been buying those Apples, Amazons, and the like, the Nvidias and so on. What do they do here? Let me just look at that, okay? They're at the trend channel, and what does the strategy tell you? That's telling you we've reached out validation, okay? That's the way it goes. In order to confirm that thing, okay, we're going to have to reach out the opposite context. These things are not out of the woods narrative stuff like that. These are the rules that I've been using on S&P 500, anything, any data point series that I have. It's documented. I'm not changing gears to whatever context we're in. These are hard-coded rules. They're in the Prezi black-white text. It's in the trading lessons. It's documented, all right? These are statistically relevant strategies. I've been using them for long enough, too long to prove that they're right. Like I've always said, people who invent patterns all over the place, most of their outcome is based on luck. They can be lucky or unlucky and stuff like that, okay? On the other hand, someone that has been consistently applying the same rules, I mean, thousands of times, dozens of thousands of times. This isn't luck. If this thing brings out money out of 10,000 times the trade, well, that means you found out something that works. And that's just what it is. I'm not overconfident and thinking that I cracked the game. I'm just saying I have statistical evidence that this thing works. And I'm just going to keep applying it. I just think it's better than switching gears all over the place. Okay, though, back to the story. If we're here, the rules tells me this is where these guys who've played the concentration games would start taking their profits. Remember, validation is where you secure the gains. That means they will put their stop losses at break even, and they will start locking in some gains. So, what does my strategy tell me now about the market context? Do I need to follow the stupid narrative of, no, bro, we're at the exponential age. Buy the Nvidia, the Teslas, the Apples and the like. They're the future, bro. They're the black holes. They're taking and sucking in all the money. Well, no, I'm not following that narrative. I know exactly what people should be doing now. They should be taking profit on these narratives risk-taking. Meaning those who bought those big names need to lock on some gains. What have I told you over the course of last weeks? I'm taking my profits on Nvidias and stuff like that. I'm not taking them all out. I'm validating my trades. So if this thing truly is the future, we're going to go there. And as this thing was a bullish range before, it could be a bearish range, which means the target is trading below the context and below the previous low point. So I know exactly when I will take my profits on the Nvidias and the like. If this is what's next, this is where we're headed. But the thing is that, is it the appropriate time now to do that thing? No, it's not. It's the appropriate time now to secure the gains if you've made those bets already. So once again, the narratives in here and the concentration are just telling you exactly the confirmation of something that should have been done before, right when people weren't caring at all. When do you think I have bought into Nvidias and stuff like that? And I missed Tesla by just a few pips. Well, that was exactly back then. That was the moment in which I bought these guys. Exactly when people say, oh, this is going to the cave, whatever and stuff. This is where I bought the big names, okay? And there are some that haven't been performing yet. So this is the question now. Is the market breadth going to go the opposite way around, like kind of consolidating. As you can see, these ranges don't go straight, line up and down. They range. I think in this area, the best we can hope for is a range. And we're looking at monthly charts. So if we look at it into context, into the weekly context, we do have signals saying, yeah, folks, you really would like to take your profits in here. The best probability is at least returning to the mean, or probably ranging, only if we will go further. But the probability in here of ranging and reversing is still significant. Remember that this thing has been building ascending top and bottom. So if we build a bottom in here, and if we go there, remember what's going to happen. Once again, not inventing anything, what's going to happen if we go there? Meaning that if for whatever reason the concentration in the top 10 assets gets reversed with a higher low point once again, building out of a trend channel, end of a cycle and stuff like that, well, what's going to happen is we're going to go immediately invalidating the rhetoric, aka this parabolic QE2 infinity by the text, whatever, it's just going to be blown away. Absolutely blown away. Because that's what we're going. Either we're going to go there, invalidating those narratives, or we're going to go there after ranging. So any way around, you know that the statistical odds are asymmetric. The probability of keep on going out of this area are much more limited than the probability of either staying there or eventually even reverse. So you don't want to be playing the concentration game. Why do I tell you that? Well, because that's exactly the same story going on right now with cryptos. I see the narrative all over the place. There's room just for Bitcoin ETF and stuff like that. The rest is, well, look at that. We've had the Ripple news and we were expecting an alt season, and suddenly all the alts came crashing just 24 hours later. So that is the clear signal that the market doesn't want an alt season. There's no alt season. There's just room for Bitcoin. Go for the big asset. That's the same story. I mean, remember, that's the absolute parallel of what we were just looking at. The concentration of the top 10 assets on the S&P 500 is exactly the same rhetoric as the dominance chart. So now let's just switch gears to the dominance chart and do that same analysis. And you will see the context is exactly the same, actually. What is this thing? It's obviously going down. Okay, we lack of history for now compared to what we've had before, but there is still significant enough history to say so. The moving average hasn't gone away from the context, so there's clearly not a trend. But is this thing going in one direction rather than the other? Clearly it's going down. We're holding candle closes below the context, and we're rejecting not even trading inside those contexts. So the reality is this as well. Is there a direction in this market? Yes, it's down. And yet, what do I see now? People selling this dominance narrative. There's only room for Bitcoin. Bitcoin is the safest. Forget about the rest. The rest is just distraction. The new narrative now is the institutions care about Bitcoin only. The rest, no, it's just speculative distraction. No, it's not. I'm sorry to say it. I mean, it's not. What you look at it says the Bitcoin dominance is a pretty terrible choice to make now. It's not the moment to do it. There's still room to grow, and we've mentioned that before, because actually if we look at the monthly chart, we've said that we lack of history. So I would say the appropriate time frame for Bitcoin is to set right in between from weekly chart, which you see have been very aggressive in here, but now the context is true in here. So the true thing is in here, look at how it's been performing, okay? We lack of history on the monthly charts, and we would be approaching the trend channel. What we know is that if we do reach the trend channel, boys, I'm going to be selling the crap out of Bitcoin and switch into other assets. And I've said it before, I am ready to press that button at any given time if it shows up. If I see Bitcoin dominance trading at 54, 55% of some sort at this trend channel, boy, I'm going to be selling my Bitcoin for Ethereum without even thinking twice about it. Eyes closed, I'll do it, because this thing has a statistical occurrence. Okay? Why is that? Well, because the other way around, this bullish Bitcoin narrative is just, okay, this would be the range. We come out at the top. We totally ignore the fact that this range is absolutely asymmetric and that we failed below moving average and stuff like that. Okay, let's just call it a neutral range. Then in that perspective, we're going to be using the DOM strategy to say we're going to take the highest high to the lowest low, and we're going to put our fibs. And in that front where we will say, okay, ignore all of it, which just says, okay, we've rejected the mid area. We're trading below the support. So the down in here, the probability is making new lows, but I mean, let's just forget about that, and let's just say, okay, the bulls narrative. So what do they target? They've been buying in here. There's absolutely no signal supporting such thing. I mean, this is, once again, I don't invent anything, okay? That's just saying this wasn't the appropriate moment to buy, to sell, but there are no signals supporting any such a thing as support in here. It's just, it was stupid to trade the alt seasons back then. Now, we were here, we see the opposite way around. Now, forget about alt season. It's not going to happen. It's just Bitcoin, folks. No, it's exactly the wrong moment to do such a thing. The worst possible moment. We're terminating a bull cycle. So, the Bitcoin maxes, they had their time around. Now they can hide themselves between any other short-term narratives. The value is playing between the weekly and the monthly. And the weekly chart says, we're overbought, folks. We're terminating cycle. Taking profits pattern have already started. This is not the time to follow these guys. This is yet another time to say, if they still can be proven right, it's a very time-limited offer. And if this thing reverses, it's not going to be pretty. Though, like I said before, the probability of a huge violent reversal and rejection, like it happened before, seems pretty unlikely this time around, because the moving average and flattenish and stuff like that. So the likeliest outcome in here, out of the three possibilities, keep going up, staying there, or reversing, is very limited chances to go higher. Far more significant chances to stay there, but non-negligible chances to go lower. And what this thing tells you anyway is that the time benefits the bears. So that's really the way it goes. If you're playing the Bitcoin narrative games, you're playing against the longer term returns. That means you very well likely have to time your entries and exits very well, because the longer you stay in position, the more dangerous it goes. That's really the way it goes. And I'm not inventing any of those things. This is not narrative. This isn't building anything. I'm just saying, look at the charts. The answers are there. That doesn't predict the future. That just says, statistically speaking, this is what you need to do. That doesn't gonna make you a genius. That doesn't make you a future forecaster, knowing anything about the future. No, it's not. It's just gonna says, if you keep on consistently playing those things, despite being dominance or S&P or any other data point series, playing an other type trade direction is less statistically rewarding out of thousands of trades. And that's what you should focus on, these thousands of trades. So please, guys, just stop playing the game of I don't want to be wrong, or things like that. And these guys seems to be much more right than Phil. You want to know what the difference is between these guys and I, is that, well, they might be right way more often than I am. The difference is I'm making money and they don't. And how does that come from? Well, that just comes from math. It just tells you that when I strike a game, I don't win just as much as I could lose. I take way more than what I will lose. And that's the way it goes. Somebody that has just 25% strike and success, as long as this person wins 5 times what it loses when it gains, and is smart enough to keep those trades open to get the 5-time rewards, well, this person is profitable. Even though this person has the worst ever success track record on history. This guy has 75% failure rate. Yet, he makes money. The other guy around, yeah, might have 75% actual success rate. The thing is that, well, if it cuts the gains too soon, and if it ends up, just like many of them do, not taking their stop losses when they're wrong, because they fear so much of being proven wrong, that when they end up being 25% wrong, they push away the stop loss or things like that. Of course, they don't tell that on social media. They will always look bright and shiny. But the reality is that, boys, I've been in this game for way too long to tell you that I know how these guys works. I've seen them over and over again, changing gears, saying something and doing the opposite way around back then, in the background. These guys are inconsistent. Though the game is all about that. Try to be consistent. And that's it. It's not about my strategy or any other strategy out there. It's just, well, any strategic that is replicated long enough does only one thing. It removes the luck part of the equation. Most of the people that I see out there, despite how rational their behaviors may look like, despite how rational their ideas may look like, as long as they don't repeat the same process over and over again with very limited personal assumptions, well, to me, that's just random guessing. And most of the time, these guys have the most dangerous bias out there. The fear of being proven wrong. So these guys are seeking being right, and you don't want to be playing that game. Don't listen to these guys. Don't listen to the narratives. Just look at the charts. The charts will always tell you which narratives you can follow, which others you can't. Okay? When some people tell you the S&P 500 can only go up, stonks and stuff like that. Yeah, sure it can. I mean, there are trends on the S&P 500, so you'd rather like to be buying it rather than selling it. But on the other way around, those who say it's going to go to the moon, parabolic bro, because QE to infinity, you know this is full of shit. How do you differentiate between the two? Well, look at the charts. Okay, guys? I feel stupid to say it and repeat it over and over again, but there is no cheat code into trading. That's the only way around that. Get rid of these guys. Get rid of the talkers. Get rid of those who switch gears all over the place. The only ones you want to follow are the ones that do the same fucking thing over and over again. And I'm far from being the only one doing that. Okay? So that's the only thing. Just wanted to recap on that before we close that one. Okay? Current, very dangerous narratives that I see all over the place. Those people saying liquidity is the driver and it's only about liquidity. No, it's not. It could be a part of the answer, but to be honest, it looks way more of a probability of a range, and the most dangerous probability would be a harsh reversal, going immediately to deflation, and that would be dramatic, because looking at the numbers of debt that we've piled up throughout the previous decades, well, that's hell of a financial crisis ahead of us if that happens. So like we stated, if the shit's really down the corner, and if you can't take out money from cash machines and stuff like that, well, we're in dip shit, folks. We definitely are. But on the other hand, well, there's nothing you probably can do about it. That's the way it goes. So how the hell do you want to bet on these things? If they happen, it's going to be shit, yeah, and you're going to have some other problems to deal with, like how to eat and stuff like that. So once again, try to be rational with what you want to be doing with trading, okay? What you do with your money and stuff like that. Betting on very statistically improbable scenarios like that, like the end of the world, the end of finance and stuff like that. Yeah, sure, shit, it can happen. But the probabilities of this to truly happen, very unlikely actually, if you think of it for a second. And if it does happen, you will have far other problems to deal with than your investments and trades. The stock market itself is going to be closed if this thing happens. There's no more stock market, there's no more finance if everything goes down. So think of it for a second. How the heck would you buy on that scenario? It makes no sense. Either you're going to take it right into the face or you don't trade it. That's where the way it goes. Okay? And for the cryptos, well, that's the same old thing. Is Bitcoin going to disappear? No. Does that thing tell you that the Bitcoin dominance is going to zero? No, absolutely not. Is the Bitcoin chart itself saying it is going to zero? Absolutely not. This thing is bullish as fuck. The only thing that I can tell you, it's a matter of dominance. And people are building narratives right now around that dominance thing to fill up the blanks or whatever there is. It is absolutely statistically irrelevant to talk about dominance. The dominance has statistically relevance to the downside as time passes. The question is, can it go slightly higher before that? The answer to that is yes, but the room to grow is far more than limited now. So the upside potential doesn't worth the risk. The time will profit for the downside version of the dominance, despite the halvings and all the shit that people can say. The charts says another story. And this chart could be wrong. Of course it can. But I'd rather like to follow the rules rather than creating endless hide-and-seek strategies. And if I get proven wrong, I switch gears to another region. That's really not what I do. And for those of you who've been listening to me for quite some time now, you know I do talk a lot. But if there's one thing I consistently have done over these years, is to trade what I see. The models that I used and all of those things that sometimes people tend to criticize me about, they never have triggered a single trade on my end. If the charts didn't tell me to do something, I never did it. The models are here to confirm, validate, or invalidate some of the theses that I create. But the thesis, it's nothing else than a thesis. The trade is always triggered on a signal in a speculative area with a defined, non-changing risk limitation. The validation are always at the same rule sets, the confirmations as well, the targets, and so on. That is today's lessons, guys. That being said, I think there were no other more important things to say, because throughout the summer, this is definitely going to be very psychologically impactful. These guys, most of them, they see their YouTube channel stats going down, so they're going to do anything trying to retain the audience and stuff like that. Any bit of volatility that's going to come up. XRP was one of it. They jump on board immediately. Bunch of scammers out the place, all over there. Immediately. So that's really the way it goes. It's going to be a summer about narratives. Don't ever fall for any of them. look at the charts first. If there's one narrative to follow, you'll know. Otherwise, if it happens at the range boundary or close to a range boundary, let them talk and don't ever listening more, and don't ever trigger any actions because of this. If you're listening to the Bitcoin dominance maxis now, they will tell you, yeah, okay, there's more room to the upside. It's not an appropriate time to go for the alts. Well, what are they going to be saying? If this thing goes from bullish to bearish, they're going to be fucked. You know what it is. If this goes there, you already know what's going to happen. The alt maxis will say, yeah, we were right, folks. This is the alt season. Are you going to be listening to them? No, you're not. If you've been playing the alt season narrative, okay, you were looking for signals. Signals exactly like that, by the way. And that's the reason why I am in the alt season camp now until proven wrong. Where am I going to be proven right? When these guys will be proven wrong, and guess what they'll do at that time around? They will switch gears right into the alt season narrative. So don't listen to them, please. All right? Try to be ahead of the market, risk take, and don't fear of being proven wrong. The charts tell a hell of a lot more interesting stories than these guys. That being said, I wish you pleasant vacation if you have the luxury to take some. There will still be irregular content throughout the next few weeks and stuff like that. I'll do my best to be there and support as much as I can. But don't forget that, folks. The recent volatility is more than just volatility. It's also causing hell of a lot of distraction. So try to read between the lines. Don't get into noise. Look at the data.